Forex is short for foreign exchange. It is the market where you can buy and sell different currencies from around the world. Imagine you are in the United States and you want to buy something from Japan. You need to exchange your US dollars for Japanese yen. This exchange is a Forex transaction. The Forex market is the biggest financial market in the world. Trillions of dollars are traded every single day. It is a global network of banks, companies, and individual traders. This market never sleeps. It operates 24 hours a day, 5 days a week across different time zones. The importance of the Forex market is huge. It helps international trade and investment happen smoothly. Without it, a company in Germany could not easily buy parts from China. People could not easily travel to another country and spend money. The Forex market sets the exchange rates for all currencies. This rate tells you how much one currency is worth in another currency. For example, it tells you how many euros you can get for $1 US. These rates change all the time, which is why people can trade them to make a profit. When you trade Forex, you are always trading currencies in pairs. This is because you are always exchanging one currency for another. Think of it like a tug-of-war between two economies. For example, the EUR-USD pair is the euro versus the US dollar. If you buy this pair, you are hoping the euro will get stronger against the dollar. If you sell it, you are hoping the dollar will get stronger against the euro. The first currency in the pair is the base currency, and the second is the quote currency. The price shows how many units of the quote currency you need to buy 1 unit of the base currency. Let's look at a simple example with numbers. Suppose the exchange rate for EUR-USD is 1.0800. This means that 1 euro is worth 1.0800 US dollars. If you think the euro will become more valuable, you would buy the EUR-USD pair. Imagine you buy 1,000 euros. You would need 1,080 US dollars to do this. 1,000 times 1.0800. If the rate goes up to 1.0900, your 1,000 euros are now worth 1,090 US dollars. You made a profit of 10 US dollars. This is the basic idea behind trading currency pairs for a profit in the Forex market. Many different groups participate in the Forex market. The biggest players are the large international banks. They trade huge amounts of currency for themselves and for their clients. Central banks like the US Federal Reserve or the European Central Bank also trade in the Forex market. They do this to manage their country's money supply and to keep the value of their currency stable. They have a big influence on exchange rates. These major institutions create the high volume and liquidity that defines the Forex market, making it possible for others to trade easily. Companies that do business in other countries are also big players. For instance, a Japanese car company like Toyota sells cars in the United States. They receive US dollars for their cars, but they need Japanese yen to pay for their costs back home. So, they must exchange those dollars for yen. This is called hedging. It helps protect them from big losses if the exchange rate changes suddenly. These business transactions are a very important part of the daily trading volume in the Forex market. They connect currency exchange directly to the global economy and the flow of goods and services. Then there are individual traders, often called retail traders. These are regular people like you and me who trade Forex from home using the internet. They usually trade with smaller amounts of money compared to banks and companies. Retail traders try to make a profit from the small changes in currency prices. They use online brokers who give them access to the market. The number of retail traders has grown a lot over the years because online trading platforms have made it easier and more accessible for everyone to participate in this global marketplace. To trade Forex, you need to know some key terms. A pip is the smallest price change in a currency pair. For most pairs, it is the 4th decimal place, like from 1.0800 to 1.0801. A lot is the size of your trade. A standard lot is 100,000 units of the base currency. Margin is the money you need in your account to open a trade. It is like a small deposit. Leverage lets you control a large amount of currency with a small amount of money. For example, with 100 to 1 leverage, you can control $100,000 with just $1,000 in your account. Leverage can increase your profits, but it can also increase your losses. Most Forex trading today happens online through special software called a trading platform. These platforms are provided by Forex brokers. They connect you to the global market and show you live currency prices. Popular platforms like MetaTrader 4 or MetaTrader 5 give you charts, tools, and news to help you make trading decisions. You can see the prices of different currency pairs moving up and down in real time. The platform is where you will place your buy or sell orders with just a few clicks of your mouse, making the process fast and efficient from anywhere in the world. Let's walk through a simple trade step by step. Imagine you believe the British pound will get stronger against the US dollar. The current price of the GBP USD pair is 1.2500. You decide to buy one mini lot, which is 10,000 units. To open this trade, you click buy on your platform for the GBP USD pair. Your broker will use a small part of your account balance as margin to hold this position open. You are now long on GBP USD, which means you will make a profit if the price goes up. Now, you watch the market. A few hours later, good economic news comes out from the United Kingdom. This makes the pound stronger. The price of GBP USD rises to 1.2550. This is a move of 50 pips, 1.2550 minus 1.2500. You decide it is a good time to close your trade and take your profit. You go back to your platform and click close on your open position. Your broker sells your £10,000 at the new higher price. Your profit is 50 pips, which for a mini lot is equal to $50. 50 pips times $1 per pip. This money is then added to your account balance. It is important to understand the difference between online trading and physical currency exchange. When you go on vacation, you physically exchange cash. You give a money changer US dollars and get back euros in cash. In online forex trading, you are not dealing with physical money. You are speculating on the price movements of the exchange rate. It is all done electronically. You never hold the actual currency. This is why online trading allows for things like leverage and short selling, which is profiting from a price drop, things you just cannot do with physical cash. Forex prices have a big impact on the real world, affecting everyone. For example, when you travel to another country, the exchange rate determines how much your money is worth there. If the US dollar is strong against the euro, your trip to Europe will be cheaper. You can buy more goods and services with the same amount of dollars. On the other hand, if the dollar is weak, your trip will be more expensive. This is a direct way that fluctuating forex rates can affect your personal finances and travel plans. The price of imported goods is also affected by forex rates. If you live in the United States and the US dollar gets weaker against the Japanese yen, then a car imported from Japan will cost more dollars. The Japanese company needs to receive the same amount of yen, so they have to charge more dollars to make up for the weaker exchange rate. This means the prices you see in stores for imported electronics, cars, or even food can go up or down because of changes in the forex market. This shows how global currency values directly influence the cost of living. Here is a simple table comparing different types of forex transactions: feature, physical exchange, travel, business transactions, online trading, retail, purpose, tourism and personal use, international trade and hedging, speculation and profit amount, small, like hundreds or thousands, large like millions, small to large, leverage, no, yes, location, currency exchange booth, banks or corporate treasury, online platform, physical cash, yes, no, bank transfers, no, electronic. In summary, the forex market is much more than just a place for traders to make money. It is the engine of the global economy. The exchange rates it sets influence the price of goods you buy, the cost of your vacations, and the profits of major companies. Even if you never place a single trade, the movements in the forex market affect your daily life in many ways. Understanding the basics of forex helps you understand how the world is connected through finance. It shows why a change in the value of a currency on the other side of the world can have a real impact on your wallet.